So here's my weekly portfolio update. I'm doing pretty well with my SPY credit spreads. I've got 3 remaining in my margin account with 3 different expirations. So May 29, June 5th, and June 8th. June 8th basically is the one that I opened on Friday. I opened it at a 274 short strike and a 269 long strike, collecting, I believe, $79. If I go to execute it quickly, I can see what I collected. Yeah, $79 or 79 cents per contract. I did 1 contract, so $79. SPY right now is trading at 293. I basically need the SPY to stay above 274 come June 8th to make money on this trade. So I've got a big range of profitability. Now my 3 remaining SPY put spreads are already showing a good profit. This one here is showing about $17 profit. Not ready to be closed, of course. This one here is showing about $27 or $29 profit. Not ready to be closed either, but very close. And this one here is showing about a $14 profit. This one is the one I opened today, and it's already showing me a profit. So I opened it for 79 cents. As you can see, it's trading right now for somewhere around 69 cents. So it's already showing a $10 profit. Now, if I go to my orders and execute it, you can see that I've closed a bunch of SPY put spreads this week. Actually, 3 of them were closed this week. 2 of them today only. Because the market keeps going up for ridiculous reasons, these SPY put spreads are working very well. So you can see at the bottom of the page here, May 26, May 26. Sold it for 90 cents, closed it for 45 cents. April 24th, April 28th. So 4 days apart. I was able to make 50% profit on the premiums that I collected to begin with. So $90 collected, closed it for $45 in 4 days. And this was a 30-day trade, and I closed it in 4 days. May 27, May 27, $80, closed it for $40. From April 27 to May 8. So this one took about a little bit more than a week. June 1st, so $74, closed it for $36 today. And it took about from May 1st to May 8th, so it took about 7 days. June 3rd, collected $78, closed it for $39. From May 4th to May 7th, so 3 days, closed the trade for 50% profit instead of waiting the full 30 days. So now I'm left with these 3 positions here that are actually close to being closed at 50% profit if the market continues to go up. And I already have a good till cancel limit order on 2 of them. So June 5th and May 29 already has a good till cancel limit order. So I'm just gonna do one on the June 8th, and I'll do it right now. So I basically click on it, make sure it's grouped by strategy, click create order entry window updates on the side here. It's already for it already gives me the closing entry. So I collected $79. I'm going to try to close it for $39, which is half. Duration, I'm going to choose good till canceled. Basically, I don't want to be in front of the markets all day. So buy to close, sell to close, just to confirm, 39 cents, which is $39 because it's 1 contract. And I can send order. Now it should appear in my orders, open orders right now. There we go. So this week alone, just through put spreads, I was able to confirm $120 of profit. But as you can see, my equity in my margin account is actually negative. I don't even have equity in my margin account. The reason for that is I have incurred a lot of losses, but I'm basically trading by leveraging my TFSA. So my TFSA is acting as collateral towards my margin account, and it's with that collateral that I'm able to trade in my margin account. If you look at my TFSA, I've got a total equity, Canadian equity of $67,742. And if I look at my positions in my TFSA, all I have really is the Qs. I've got 134 shares of the Qs that I bought at an average price of $221. Right now, the Qs are trading at $224. But the problem is, on 100 shares, I've got a covered call that I sold May 15 expiration at $211. So basically, that $211 strike means that my max selling price is $211 on this position. While the stock is trading at $224, I could only sell it at $211. So I'm missing out on all that capital appreciation, $224 minus $211. Especially that I bought it at $221, so it's actually going to be a loss for me. But my strategy with this is I keep rolling the call option forward. So I'm not going to let my shares go away at $211. I just keep rolling the call option forward every week, moving it a strike higher. So next week I'll try to move it to 212, for example. And every week I'm trying to roll the call option forward. I do it for a credit. I'm collecting some sort of credit, rolling the call option forward. And at least I've got 34 shares of the Qs that don't have a covered call against them. At least these ones are going to be profitable if I just leave them and the Qs keep going up. So just to give you an example of what I mean by rolling a call option forward, for example, this one expires May 15. If I want to roll it to May 22nd, I can click create order, remove the shares, because I just want to roll the call option forward. So I'm going to have to buy back the call option. I'm going to click add call. I'm going to click sell. I'm going to choose May 22nd expiration, but I want to choose a higher strike. I want to move forward and higher because the Qs is already trading much higher. So if I go to 212, see right now I wouldn't be able to do it for a credit. I would only be able to do it for a small debit. But if I want to do it for a credit, then I'll have to keep the same strike of 211 and I could do it for probably $70 credit. But I want a higher strike. So what I could do is, if May 22nd doesn't work, I can go to May 29th and then choose a 212 strike. And in this case, I can do it for a credit. So I've gone $1 higher and I've collected a credit at the same time. Let's see if I can go even higher. Let's just see if I can go to 212.5. Yeah, I see at 212.5, I could collect a smaller credit of about maybe $15, but at least I'd be at a 212.5 strike, which is higher than my 211 strike. IMGN, as you see here, was a bad covered call trade that I'm just trying to get rid of. And I think I'm going to have to wait till July 17 to get rid of this position, but it's not something I want to hold on to. I still have some capital available in my TFSA. I've got about 26,000 Canadian buying power, but honestly, all I want to do is buy ETFs like the Qs or SPY or IWM, but everything is super high right now, so I want to wait just in case the market crashes. If the market goes up, I mean, I have positions, so I'm okay. If the market goes down, well, I have some capital to buy some positions if the market goes down. But if the market goes down, I'm only going to be buying the Qs. So I'm going to be lowering my cost basis on this position here. And it's actually something that I want. I actually want the stock to drop because I want it to drop below 211 come May 15 so I don't lose my shares at 211. In my RSP, all I've got is IWM, which is the ETF that tracks the Russell 2000. I've got a covered call trade on it, but this one's doing better because my purchase price is 151. The stock is trading at 132, so that's one thing. I'm losing money on the stock, but I'm selling call options every week. And the next call option that I have is May 15, so next Friday. And I've got a 139 strike, and the stock is trading at 132. So currently, as we stand, it's 7 points away, so it's kind of safe. And I collected $43 to sell that call option. So every week I'm rolling the call option forward for a credit. But in comparison with the Qs, this one is safe because my strike is higher than the current market price. But in the example of the Qs, my strike of 211 is lower than the current market price. So that's the difference. But regardless, I'm keeping the position and I just keep selling call options every week as much as I can, and basically generating income from a buy and hold position. That's the idea here. And my total balance right now in my RSP is sitting at 30,000 Canadian, and I've got about 4,800 Canadian of buying power, just waiting to buy something in case the market drops. So really, the best way to prepare for a market crash, no one knows where the market's going really, but it's just to prepare for both scenarios. Prepare for a scenario where the market goes up, and prepare for a scenario where the market goes down. The only way I know of doing that is to buy a little now, but keep a little bit in cash in case the market drops. Not the whole portfolio, of course, but keep a little bit in cash just in case the market drops. In my RESP, I'm sitting at a total equity of 87.54 Canadian. I've got 825 buying power Canadian. All I've got in my RESP is Dell. I'm doing a covered call on Dell. I bought it at $40. Right now it's trading at $43. But I'm missing out on that capital appreciation. So you see there's a $400 profit here. I'm missing out on it because I've got a covered call at 40. So When I have a covered call at 40, that means my max selling price is that strike of 40. But in exchange or in return, I keep collecting premiums every month for selling these call options. And who knows, maybe Dell will drop again. My expiration is May 15th, so next Friday. Who knows what it will be trading at next Friday. But let's say I wanted to keep the shares. I want to keep the trade alive. All I could do really is buy back the call option. So click create order, remove the shares, click add call. I'm buying back the May 15 expiration, and I could sell the next available expiration, which is June 19. If I choose the 42.50 strike, right now I've got a 40 strike, but if I choose the 42.50 strike, I will have to pay to roll it forward. But at least I'll get $2.50 of capital appreciation. But who knows, maybe by June 19, I paid a debit to move the call option forward to 42.50. But what if by June 19 it drops back down to 40? So I paid for nothing. So I always want to roll forward for a credit. So to roll for a credit, in this case, I'm going to have to choose a 40 strike. And by choosing a 40 strike, basically the same strike, and it doesn't matter because my cost is 40, I'll sell it at 40, but I'm collecting a premium of anywhere between probably $140. But that won't be the first time. I've already collected premiums on this position, and I could do it again up until June 19, collect another $140. So if I look at the premiums that I've already collected on this position, if I go to executed and filter on Dell, I've got about $90 here, $124, $170, and potentially another $140 if I roll it to June 19. And I've got $45 when I initially opened the trade. And my other position is MasterCard. I really like MasterCard as a company, as a consumer. So I would gladly buy into MasterCard. And MasterCard and Visa are just stocks that always go up for some reason, like an arrow. So this is something I'm just going to hold for 15 years, never touch it. And I would like to buy more if it drops. At some point it was trading in the 240s. I was going to buy, but I wasn't sure if it was the lowest point, and looks like I missed out. So right now my buying price or my average cost is $275, and the stock is trading at $282. So it's showing a small profit of $40. But anyways, I don't plan on selling it in anytime soon. I really plan on holding this one for 15 years. But I would like to buy more of it if the opportunity comes. Now, going back to my covered call trade on Dell, let's say I really want to go at a higher strike. I want to go at a 42.50 strike. Then I could accept to pay a debit. Or the other thing I could do is I can go further out. So right now, my current call option is May 15. So I'll have to buy back the May 15 and then sell the June 19. But if I want, I can sell the July 17. So I can go 2 months out. So I can collect a credit and go at a higher strike of 42.50. That's if I really believe that the Dell is going to keep going up and I want to collect that capital appreciation. So I could go to 42.50, July 17. I can collect $40 out of this rolling of the call option. And if by July 17 Dell is at 42.50, well then I've just gained an extra $250 of capital appreciation. And guess what? On July 17, I could roll the call option again forward depending where the stock is trading at. So if this is something I want to hold forever, which Dell is a stock I do want to hold forever because I like the company. I think they're doing well. The revenues are always growing. And just as a consumer, basically the way I judge a company is as a customer, am I happy with the company? Is it a brand that I'm comfortable owning? I really do appreciate a company that understands customer service and takes care of their customers. So going back to my margin account and SPY put spreads, if you really want to understand how this strategy works, I've got a bunch of videos on SPY put spreads. I'll link one of them below, but you can also go on YouTube and just search put spreads just to understand how they work, put credit spreads especially. But what I like about it, first of all, is that it's an option selling strategy. So I'm not even using money to get into the trade. I'm actually collecting money, opening the trade, I'm collecting credit. And then to close the trade, I have to buy it back. But hopefully you buy it back at less than what you collected. Or I could let the trade expire worthless. But because the market's going up so fast, it's just so much easier to close the trade early for 50% profit of the premium collected initially. I also like it because I don't have to time the market at all. I don't have to guess the direction. I don't have to make any research, any analysis. Regardless of where the SPY is trading at, I'm going to sell a put credit spread, collect a credit. The only difference is whether I keep that credit or not. But most of the time, I'm going to keep the credit. And if I don't keep the credit, there's ways to manage the losing position so that you don't lose as much. So with a total equity of about 88,000, my portfolio is slowly creeping up after it dropped from 107 to almost, I think, 70,000. So I guess I'm on the right track. The only issue I have really is my covered call on the Qs. That's really the only thing that's bothering me, because I'm missing out on a good capital appreciation, but I'm also missing out on my cost basis. I mean, my cost is 221. I might be forced to sell it at 211. I'm not going to let the shares go at 211, but theoretically, that's what my situation is right now, is I'm stuck at a selling price of 211 on 100 shares, so it's almost $1,100. Alright, if you have any questions, leave them in the comment section below. If you want to open an account with Questrade to trade on the stock market, use one of my referral codes in the description below. One of them allows you to get up to $250 back, but it depends on your deposit. So $1,000 gets you 25, $10,000 gets you 50, and so on. Or you could use the other referral code that gives you $50 in free trades regardless of your deposit. And if you want that one, you can just click on the link here. All right, thanks for watching.